You sat in this almost exact same spot last year, and you said it was a great market to sell into. Is that still the same today?
Well, I would say the market continues to be very attractive. If you think historically about the cost of capital and below investment grade financing, this is still an incredibly good time to access that marketplace. And the market is vibrant, and performance continues to be very good, and inflows are strong. However, for sure this year we've seen more volatility in concert and sympathy with the broader market environment. So it's been a little bit rougher ride this year, and so it's not quite as singularly good as it was last year, and we're seeing a bit more discerning behavior on the side of the credit investors who are, I'd say, more focused on seasoned credits that they understand and know well, and a little less desirous of owning riskier, kind of off-the-run, more storied credits.
One area where we are seeing some risk being taken on is M&A. If you look at the Takeda Shire deal, Takeda was downgraded on that. Walmart Flipkart just this week, Walmart is potentially going to be downgraded on that. We're talking about AT&T, in theory, taking on $160 billion of debt if they do the Time Warner deal. Have credit ratings taken a sort of back seat to M&A opportunities in this market?
I would just observe that we're in an extraordinary time right now for strategic activity. There's disruption in all these industries, and some more pronounced than others. Companies really have to react and deal strategically with what's going on around their own businesses and looking to expand into other areas. And that strategic behavior is really taking precedent over almost anything else in their arsenal. So it's not that companies want to get downgraded or want to reduce their credit profile, but the strategic imperative is certainly taking precedence.
But does that mean companies are taking on much more risk than they perhaps should be?
I would argue that it's not the case. I would argue that it's a great time to be taking on extra debt and levering the balance sheet right now. Cost of capital is extraordinarily attractive by any historic measure. And when you've got a strategic imperative and you can still finance at such attractive rates and the capital is available and it's quite accretive in terms of value creation, if you really believe in your strategy and your business plan, it's a great time to be accessing that capital.
Now, we're here to talk about lending. Obviously, this conference is all about lending. Goldman have moved up the debt lending business sort of rankings quite a lot in the last few years. How has that been achieved? Have you had to take on more risk to do that? Have you moved up the curve in terms of, I suppose, what you're comfortable with?
Well, I would say our franchise over a long period of time has been marked more by equity and M&A orientation. And we certainly recognized a long time ago that we needed to build a bigger debt business and a bigger debt franchise. And we really thought about it in an integrated fashion. So this conference is 500 investors and 80 issuers, and it's jointly owned by our securities division and by investment banking. So we view the business as really an integrated platform where you must have an origination capability on the banking side, coupled with a sales and trading capability where you can distribute that originated product. And if you don't run it in an integrated fashion, you're not going to be successful because the distribution capability is really, really important to taking on whatever risk you're going to absorb at that moment in time. So we're very proud of what we built. We have a top 3 franchise in the debt business across investment grade and below investment grade. Here we're talking more below investment grade. But we're very, very strong in the business, and we continue to be focused on it. It's very strategic for us vis-a-vis our M&A franchise. You asked about cash-financed, debt-financed M&A. Were we not to be a big player in the debt business, we wouldn't be as important in the M&A franchise. So we view those as very symbiotic and strategic.
What leads what in that sense? Because Goldman has always been very strong in M&A. Does the M&A business bring in the debt business, or is it sort of the other way around, or a mix of both?
We always think about leading with building trusted advisory relationships. So we want to be the CEO, the CFO, the board's advisor. We want them to think of us as their holistic advisor across all things that are important to them. And obviously that starts with strategic advice on what's going on in your industry, in your company, and how are you trying to create value and how are you trying to compete over time. And we try to bring the other capabilities, debt financing obviously being an important one, risk management, hedging, market perspectives and so forth as a component piece of a more holistic solution.
Now you have new entrants coming into this market. Some of the non-bank lenders, we've seen a lot of private equity get into the debt business. How do you, as a more regulated entity, how do you compete with that?
We still think we have the best platform of anybody to understand what's going on with companies in the world globally across the whole of the sets of industries that compete around the world. So we like our position in terms of understanding how to originate product, if you will, for debt investors. There will clearly be other participants that want to buy that product, but we don't think anybody has the capability that we have to actually find those issuers and understand what their needs and ambitions are and how to find the origination of that product is still, we think, a very unique skill that nobody else has a better capability than we do.
So it doesn't push an institution like Goldman to take on more risk just because you have more competition.
No, I don't think we necessarily have to take on more risk. We obviously look at every situation, as a micro situation, and then we think about a broader portfolio. So there may be times where we're taking risk on a certain transaction that we think is prudent risk in the context of what's going on in that market, and there may be other times we're not prone to take that risk.
I got to ask you a Bitcoin question. So we in the media, look, we've asked a million Bitcoin questions to Goldman, really when there was no Goldman Bitcoin issue. Now there is an issue, so I can ask a non-speculative question. You announced recently that you will start trading contracts related to Bitcoin as an institution. Why? Why now?
Well, I would just say we've got obviously a number of clients that are important, constituents to us that continue to ask and demand and desire to have the ability to play in that market, in that arena. And so it would be difficult for us to continue to avoid and ignore that and say we're not interested in participating with you and providing that service to you. So I think we feel like it's the time now to start dipping our toe in and getting involved and trying to find ways to be of service to the clients that really would like to have exposure in that way.
Is it something you think other banks across the street will dip their toes into?
I don't have any speculation on what other banks will do. And you guys seem to love Bitcoin.
We do. The media, it's an obsession for the media. So let's talk about the M&A cycle. We were talking just off air. I think we're in about the 6th year, or we're going into the 6th year of an M&A cycle. You've been around longer than me. You've seen these cycles come and go. Where are we right now in this cycle?
We try not to observe what year, what inning, whatever analogy you want to bring. I would just say I think the conditions right now are about as good as I've seen at any point in my career in terms of the breadth and the depth of the participants in the M&A market. We have global growth that's quite coordinated for the most part around the world, which leads to lots of activity, lots of economic activity, and people are more on the balls of their feet. Their CEO confidence, that I would say, is rising, not declining. In the United States, the tax package certainly created more, I'd say, confidence and positive sentiment, and importantly, a lot of cash that is increasingly accumulating on balance sheets, which is going to need to be invested in some way, shape, or form. And so we spend a lot of time with companies thinking about that excess cash, if you will, that's being accumulated and what to do with it. Some of that cash will go back to investing in the business. Some of that cash will go back to return of capital to shareholders, and some of that cash will undoubtedly be used and has been used for strategic purposes in M&A. And so there's all that kind of positive momentum from that standpoint. And as I said earlier, there's a tremendous amount of disruption in many of these industries. And so if you're sitting there with a lot of cash and a lot of disruption, it's kind of a nice cocktail for strategic activity. And the third point I would make is there's not only offensive behavior around trying to find ways to deploy your cash, but there's increasing pressure from shareholders, be it activism or otherwise, on what I would call fit and focus. So in certain industries, there's a real demand for you to skinny down and be less of a conglomerate type company and be more focused on the areas where you really bring leading expertise and where investors can have a pure play. So you've got offensive behavior, you've got defensive behavior, and you have it across all industries, and you have it globally, and it just leads to quite an extraordinary environment. So I don't know what inning we're in, but it feels quite good right now.
One area where we see just a ton of activity right now is media. We've got obviously Comcast and Disney both around Fox, a company you're very familiar with. We've got AT&T and Time Warner. What's driving so much consolidation in that space? Are these defensive deals? Are these deals to stay relevant in the face of sort of Google and Facebook coming into and Amazon coming into the space? Or are these just things that make sense because it makes sense to get bigger?
Well, I think you're seeing the desire for scale. I think having the rise of the technology players, whether it's Apple, Amazon, Google, as you mentioned, and the enormous amount of liquidity and capital and cash that they have to deploy, and their impact in disrupting the way people consume information, media, data, et cetera, is definitely having a real impact on some of the more legacy players in the media business, in the telecom broadband arena as well. So I think that is definitely driving a lot of activity, and the desire for scale is part and parcel of being able to compete in an ever increasingly competitive environment with more need for capital and more need for the ability to compete for programming, to compete for broadband, and there's the dollars at stake are much bigger.